Learning module, forward commitment and contingent claim features and instruments. Topic: forwards, futures, and swaps. A primary distinction between a forward contract and a futures contract is that a forward contract A is mark to market daily while a futures contract is not. B is a customized over the counter agreement while a futures contract is standardized. C can be used for hedging while a futures contract cannot. Forwards, OTC, customizable, flexible, but higher counterparty risk and settled only at maturity. Futures, exchange traded, standardized, daily mark to market with margin accounts, lower counterparty risk due to clearinghouse guarantees. The core differences between forwards and futures hinge on three aspects. Trading venue, forwards are OTC, is private, customized, futures are exchange traded, is standardized. Customization versus standardization. Forwards allow tailored terms, futures follow fixed specifications. Settlement process, forwards settle once at maturity, futures settle daily through mark to market with margining. Forwards and futures share core features as firm commitments. Both obligate long and short parties to transact at a set price on a future date. Both have zero value at initiation, can be used for hedging or speculation, and have linear, symmetric payoff profiles. Neither requires upfront payment, aside from margin or collateral. What distinguishes them from options is that options are contingent claims with asymmetric payoffs and require an upfront premium. This topic is about futures. Wellington Partners owns a large position in SolarFlex Incorporated shares and wants to synthetically eliminate this exposure for a 9-month period due to a planned strategic review without immediately selling the shares. To achieve a payoff profile that mimics having sold the shares today, Wellington should A. Take a long position in SolarFlex futures contracts expiring in 9 months. B. Sell put options on SolarFlex stock with a 9-month expiry. C. Take a short position in SolarFlex futures contracts expiring in 9 months. A short futures position perfectly offsets a long stock position. Futures are linear firm commitments with symmetric payoffs. A short futures gains when the stock falls and loses when it rises, giving delta equals -1 exposure. Combining long stock plus short futures replicates selling the stock today, locking in value, and eliminating equity risk without an actual sale. A short futures position acts as a synthetic sale of stock. It locks in the future selling price and offsets the long equity position 1-for-1, delta equals -1. Payoff is linear and symmetric, perfectly mirroring gains or losses of the stock. This creates the same economic effect as selling the shares today, but without actually selling. Neither a long futures nor a short put option neutralizes equity exposure. Long futures add +1 delta, doubling risk instead of eliminating it. Short put has an asymmetric payoff with limited upside and large downside risk, leaving residual exposure and not replicating the stock sale. Firm commitments, binding, linear payoff, full hedging or replication. Contingent claims, optionality, nonlinear payoff, insurance or speculation. Full elimination uses short futures or forward, same horizon. Partial protection uses long put, preserves upside, limits downside. Avoid short options. They introduce risk, not remove exposure. This topic is about options. Grayson Holdings maintains a significant investment in next-gen robotics NGR stock. The portfolio manager has a strong conviction that NGR stock price will appreciate over the next year, but is concerned about potential short-term volatility and wishes to limit losses from a significant price decline. Which of the following strategies will best achieve the manager's objective of maintaining full upside potential while defining the maximum possible loss? A. Sell NGR call options expiring in 1 year. B. Purchase NGR put options expiring in 1 year. C. Enter into a long NGR forward contract settling in 1 year. A trader purchases a 3-month European call option on the S&P BSE Sensex with a strike price of 58,000 rupees. The option premium is 2,800 rupees. At expiration, the Sensex settles at 60,300 rupees. Which of the following correctly states the option's payoff and profit? A. Payoff equals 2,300 rupees. Profit equals negative 500 rupees. B. Payoff equals 2,800 rupees. Profit equals 0 rupees. C. Payoff equals 2,300 rupees. Profit equals 500 rupees. Which of the following statements accurately describes the default risk in an option contract? A. The long is exposed to default risk from the short. B. The short is protected from default risk. C. The long has no default risk exposure to the short. An investor sells a European put option on a stock. The option premium is $8 and the exercise price is $65. If the stock price is $58 at expiration, the profit to the option seller is closest to A. Negative $1. B. $1. C. $8. An investor writes a put option for a premium of €3.50. The option has an exercise price of €80. At expiration, the underlying asset's price is €76. The payoff to the put option seller is A. Negative €4. B. Negative 50 cents. C. €4. A trader sells a put option with an exercise price of 40 yen for 1 yen and 50 cents. If the price of the underlying asset at expiration is 35 yen, the trader's profit is A. Negative 3 yen and 50 cents. B. 3 yen and 50 cents. C. 6 yen and 50 cents. An investor buys a call for €8 that has a strike price of €200. If the value at expiration for this call is €15, the price of the underlying at expiration is closest to A. €185. B. €215. C. €223. A protective put strategy combines long stock with a long put to cap downside while keeping full upside. Long put guarantees the right to sell at the strike, limiting losses. If the stock rises, the put expires worthless and upside is fully retained. Net cost is only the premium paid, making it a clean way to define maximum loss while preserving gains. Protective put equals downside protection with unlimited upside. Neither a short call nor a long forward provides the protective cap downside structure. Short call caps upside and leaves unlimited opportunity cost if the stock surges, so it violates the goal of retaining full upside. Long forward adds extra long exposure, delta +1, leaving unlimited downside risk instead of defining a maximum loss. Only a protective put, long stock plus long put, achieves cap downside with full upside. Short calls and long forwards fail this objective. Firm commitments such as forwards, futures, swaps are binding, linear payoffs, best for full replication or complete exposure elimination. Contingent claims such as options, CDS, are rights not obligations, and non-linear payoffs, best for insurance-like protection, are asymmetric hedging. Long options, like protective puts, are the only way to define a maximum possible loss while preserving upside. Short options are long forwards do not achieve capped downside and should be avoided when the goal is insurance-style protection. Use firm commitments for full neutralization and long options for bounded loss, asymmetric protection. Being in the money doesn't guarantee profitability. Payoff equals intrinsic value at expiration, ST minus X. Profit equals payoff minus the premium paid. A call can finish in the money but still result in a net loss if the premium exceeds the intrinsic value. Always distinguish payoff from profit. Option profitability depends on both strike and premium. Payoff and profit are not the same. Payoff depends only on the option's intrinsic value at expiration, max of 0, and ST minus X. Profit subtracts the premium paid, so it can be negative even if the option finishes in the money. The rule is clear. Profit is less than or equal to payoff, and payoff ignores the premium, while profit accounts for it. Always separate payoff or intrinsic value from profit, the net after premium. Payoff is the terminal intrinsic value at expiration. Payoff ignores premium. Profit equals payoff minus the premium paid, reflecting the true economic result. Break-even equals strike price plus or minus premium, X plus C0 for calls, X minus P0 for puts. Payoff shows value at expiry, profit accounts for cost, and break-even defines the price where profit equals 0. Long side pays the premium, holds only a right to buy or sell, no further obligations. Short side receives the premium, carries the contingent obligation to deliver or purchase if exercised. Short side keeps the premium if the option expires worthless, but must perform if exercised, so they are not shielded from performance risk. Long side has no obligation beyond the premium, but is exposed to the short's potential default when the option has value. The difference in counterparty risk between firm commitments and contingent claims. Forwards, higher mutual default risk since no clearing, trade ODC, and no daily settlement. Futures, daily mark-to-market, and clearinghouse guarantee minimize counterparty risk. For options, contingent claims, only the short has an obligation. Thus, in OTC settings, the long is exposed to the short's default risk upon exercise. For exchange-traded or cleared options, clearinghouse removes counterparty risk for both sides. Payoff for short, put equals negative intrinsic value equals -7. Profit equals premium received plus payoff equals 1. Maximum profit equals premium $8, only if the option expires worthless. The rule is clear. Profit equals premium minus intrinsic value, and it cannot exceed the premium. Short put profit is premium minus intrinsic value. Maximum profit is the premium, not the payoff. Short put profit formula. Premium plus negative max of 0 and X minus S at time t. Maximum profit equals premium when ST is greater than or equal to X. Break even, X minus premium, ST equals 57. Limited downside because the underlying price cannot fall below 0. The maximum loss is the exercise price minus the premium, 65 minus 8 equals 57. Payoff at expiration, negative max of 0 and X minus ST. Payoff is the terminal cash flow at expiry. Payoff ignores premium. Profit equals payoff plus or minus premium. The seller adds the premium, while the buyer subtracts it. Short put specifics. Maximum payoff is 0, worthless option. Minimum payoff is negative X minus ST, limited downside if ST is 0. Premium caps maximum profit, but provides only a small buffer against losses. Short puts carry limited downside risk because the price of the underlying asset cannot fall below 0. The maximum loss is X minus P0, the exercise price minus the premium received. Payoff represents intrinsic value only. Profit includes premium. Always separate payoff, the expiry value, from profit, the net after premium, since a short option can show a negative profit, even when premium was collected upfront. You must distinguish between the payoff, which is solely the terminal value of the option, the negative intrinsic value for a seller, and the profit, which is the payoff plus the premium received. For short put, a net loss occurs specifically when the intrinsic value of the option is greater than the premium collected upfront. While the seller's profit is capped at the premium received, they face significant downside risk because they are obligated to purchase the asset at the strike price, X, even when its market value, ST, has dropped significantly. Risk is limited downside if ST falls sharply, since the seller must buy at the strike when the market value is far lower, but the loss is capped because the asset price cannot be negative. Short puts earn limited premium upside, but expose the seller to large downside risk, with break-even as strike minus premium. For call buyer, unlimited upside, maximum loss equals premium. Call seller, maximum gain equals premium, unlimited loss if price rises. For put buyer, maximum gain equals strike minus premium, maximum loss equals premium. Put seller, maximum gain equals premium, limited but large downside risk if price falls sharply. Option buyers have limited loss and asymmetric upside, while option sellers have limited gain, premium, but potentially large are unlimited losses. Seller is opposite of buyer. Seller's maximum gain equals buyer's maximum loss. The premium. Shortcut rules for option buyers versus sellers. Value at expiration is synonymous with payoff or intrinsic value and does not include the premium. Profit is the net result after subtracting the initial cost. The premium paid at initiation affects your profit and your break-even point, but it has no impact on the option's value at expiration or the underlying price required to reach that value. If an option has value at maturity, the underlying price, ST, is simply the strike, X, plus the payoff, CT. If it has no value, the underlying price must be less than or equal to the strike. This topic is about forward commitments versus contingent claims. Zenith Asset Management holds 5,000 shares of Aerodyne Incorporated and plans to retain the position for 8 months. To hedge against adverse moves, it considers either 1. Entering a short forward contract maturing in 8 months, or 2. Buying a put option with the same maturity and a strike equal to the current forward price. Assume Aerodyne's share price rises by 12% over the period. Which of the following statements is most accurate regarding the relative performance of the two strategies? A. The short forward produces a smaller loss than the long put if the forward price exceeds the initial spot price by more than the put premium. B. The long put results in a smaller loss than the short forward if the magnitude of the forward loss exceeds the put premium. C. Both strategies yield identical losses because the strike equals the forward price and the underlying moves identically. An investor purchases a forward contract in a call option. Both derivatives have the same maturity date and underlying asset. The forward price is 120 euros. The call option has a premium of 5 euros and a strike price of 120 euros. If the profit on the call option is 0 at maturity, the price of the forward at maturity is A. Less than the price of the underlying. B. Equal to the price of the underlying. C. Greater than the price of the underlying. The loss exposure. For short forward, losses grow linearly with rising prices, no cap. For long put, if ST is larger than X, option expires worthless, loss fixed at premium. Long put limits loss to a known amount, premium, while short forward exposes the investor to unlimited loss as prices rise. Long puts cap losses at the premium, whereas short forwards carry unlimited loss potential when the underlying price increases. Compared irrelevant metrics like F0T minus S0 are assumed equal losses across all outcomes, which is impossible since ST minus F0T varies, while the premium is fixed. Loss comparison must focus on ST minus F0T versus the fixed premium, not cost of carry, or assumed equality across scenarios. Firm commitments, symmetric, linear obligations. Contingent claims, asymmetric, non-linear payoffs with limited loss and potentially unlimited protection or upside. Forwards expose both sides to unlimited linear risk, while options cap the buyer's loss at the premium and provide asymmetric protection. The put hedge limits losses to the premium, while the forward hedge captures full downside gains but suffers unlimited losses on upside moves. Forward price is fixed until settlement, while spot price moves. Option payoff depends on spot versus strike, and profit accounts for the premium. Forward price is not the underlying price. Forward price is contractual delivery price, not market price. Forward contracts lock in a fixed delivery price with linear payoff, while options depend on spot versus strike, with profit shaped by the premium. Forward price is fixed, spot price moves, and break even for options occurs when the underlying rises by the premium above strike.